if your favorite designer bags drops 40% in price overnight, would you actually panic or would you add to cart? I feel like a lot of us would add to cart instead of panicking. So why is it then that when stocks drop, we run the other way and then we start to panic? Today, we're going to be talking about one of the most misunderstood opportunities in investing. I'm going to show you how to figure out whether a dip is worth buying or if it is a danger sign. Stay with me because this one could genuinely change your life and how you invest. Do me a quick favor before we proceed. Do not forget to like this video, share with your friends and family, and subscribe by hitting the bell icon. It generally helps this channel reach more women and more people that are interested to learn about investing. Now, let's get to it. Now, what is a 52-week high? And why does it even matter to you as an investor? A 52-week high is simply the highest price a stock has traded in the past 1 year. You'll see it listed on every investing app such as eToro, Trading 212, and Robinhood. Now, here's the thing. When a stock is sitting at its 52-week high, people get excited, news cover it, social media is buzzing, people are genuinely happy. And everybody wants in, of course, because that stock has been making higher highs and has just been going up. Usually, this is when the price is most expensive. But when the stock drops from that high, that's when people panic and they start selling, thinking that something is actually wrong with the company. But what if something is not actually wrong and the market is just doing what it knows how to do best? That is exactly what we're going to be breaking down in this video. There are a bunch of reasons why stocks tend to fall from its peak. Not all of them are bad news, so let's break them down bit by bit. Number one, profit taking. This is usually one of my favorite parts because I am also a profit taker. When a stock hits highs, all investors that bought when it was low would do what is naturally done, supply and demand. They take their profit to lock in their gains. And that selling pushes the price of the stock down. Like I said, supply and demand. Number two, earnings disappointment. This is another reason why the price of stocks can actually fall from its peak. Sometimes a company reports earnings and investors are not pleased with what the earnings are. That's usually because stocks are actually priced in with good news. If a stock was priced like every single thing will be perfect, and then the earnings come and the earnings were not as amazing as expected, the stock price begins to fall. So we could actually call that a market correction. So the moment this earnings results come in, even if it is slightly below expectations, the market starts to react and the price of the stock starts to fall. This is called price for perfection, and it happens a lot, especially with popular stocks like Nvidia, Meta, Tesla. Number three is macro events. So we have micro and macro events, and they also impact the stock market in various ways. But for number three, we're going to be talking about macro events. Macro events are simply interest rates decisions and inflation data. Sometimes the whole market pulls back and even great companies get dragged down with it. The stock didn't do anything wrong. The environment just shifted. So whenever interest rates get increased, the stock market tends to pull back and drop. Why? Because lower risk assets are now available at a higher interest. So people tend to lean towards that. Same way, if the interest rate gets dropped, the lower risk asset loses its appeal because why would I want to keep a lot of money for a meager interest rate? So what happens is investors now move back to the stock market. Number four, sector rotation. So big institutional investors, think of them as fund managers. Think of your pension funds. Think of Vanguard, Fidelity, BlackRock, Blackstone, JP Morgan. They regularly move out money from sectors. So institutional investors are investors that have a lot of money to put into the market. So there are two types of investors. We have institutional investors like JP Morgan, Vanguard, Fidelity, and then we have retail investors like you and me. So these guys are people that have a lot of money to pump into the market, pump into capital market, stock market. And so whenever they sell or pull out their money, the market always tends to react. So sector rotation is where these big institutions move out money from sectors that they think have run up and into other sectors that they think has now become undervalued. This move alone can tank a stock even if the company is performing brilliantly. Number five is the hype wearing off. So in recent times, consumer sentiments and hype can drive the price of a stock. Case in hand example, GameStop. So individual sentiments is when there are lots of buzz surrounding a stock and this leads to more people wanting to get in and have and enjoy a slice of the pie. So when there is a lot of buying pressure, what this does is it drives up the price of a stock. So when hype wears off, when the excitement behind the stock starts to wear off, the stock price starts to drop. And eventually the hype dies down and then the stock corrects back to reality. This is that time where a market correction occurs. Now, this is where I need to keep it real and honest with you. Not every stock will recover when it falls from its highest trading peak. There are certain factors and reasons that determines if a stock is going to recover when it falls from its peak. So number one is strong fundamentals. Any stock that has strong fundamentals, whenever there is a pullback or a correction, that is usually a temporary setback. Case in hand is Apple, for example. So a solid company like Apple having a rough quarter because of supply chain issues will not result in a pullback in price, a reduction in price, but that is only going to be temporary because Apple is a company that has strong fundamentals and it's also a solid company. Historically, quality companies like this do recover and then go on to achieve newer highs. Number two, structural business problems. This is where a company's actual model is broken. Think of companies like Kodak and Blockbuster. The world moved on and they didn't move on. These stocks never recovered because their business models simply didn't recover. Number three, speculative and hype driven stocks. Like I said earlier, these are stocks that are purely driven by hype, excitement, people being speculative about the stocks. So this can drive price up, but when those stocks eventually fall down, they never go back up because there is no fundamental, there is no business model, and there is no mode backing such stocks. Example of these are meme stocks or stocks of companies that have not made real revenue. So here is the question to ask whenever you see a stock drop from its all-time high. First question is, why did the stock drop? You need to understand the reason behind the drop. Number two question you need to ask, does the reason for that drop threaten the long-term business of the stock? If the answer is no, then most likely the reason for the drop could be either temporary or emotional market behavior. This can now become a buying opportunity for you as an investor. But if the answer to the questions you asked is yes, then that is a business risk and it is definitely not a buying opportunity.